presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compak YouTube Weekly Update. I'm Mo Ansari. This is for March the 11th, 2024. Don't forget to subscribe to this channel. Just click on the subscribe button and you can get an update whenever I post an update for you, so you can see all the charts that I talk about. Also, you can just go to compak.com/media and get all of our communications absolutely free. The weekly podcast, the weekly YouTube update, the one-pager that we put out every week, just a newsletter. You can also register for all the upcoming events. And don't forget, day after tomorrow, we have a webinar. It is free. Make sure you sign up for that also. Looking at the markets, first week down. We were down slightly for the S&P, still hovering around all-time highs in the market. So I think we're just getting a little tired, as I've been talking about for the last 3-4 weeks. We go up a little, down a little, and that's how tops are formed. They're not V bottoms like we see at bottoms where the market comes down and snaps right back up. Tops are usually a process. All the people that have missed the market, they've been sitting on the sidelines, finally they're jumping in. Other people are taking profits, so it's going back and forth. The Russell was positive for the week. It continues to move higher. It looks pretty good. If we're looking at the NASDAQ, that's the one that gave back some of the gains. And I think that's the one that is driving the market. So a little bit of correction pullback there would be good overall. Utilities were the best performer last week, and that was because interest rates came down. We got the unemployment numbers, even though the headline was good, but we saw the number go up to 3.9%, the unemployment. That is up 0.5% from the lows that we made last year, and unemployment is slowly starting to go up. Also, overall, the numbers were a little bit softer if you look underneath the headline numbers, and I'll talk about that with Javed on the podcast, so make sure you tune into that so we get into more detail on that. That is the first sign. For the last 2 years, I've been saying simply that it's a recession or a slowdown is going to be tough because of the unemployment holding up. But if unemployment starts to go up, that is when people close their wallets. That's when people get a little bit nervous for spending, and that's what we're going to see. Oil was up nicely last week. Gold was up big. As I mentioned, interest rates were down. The 10-year was down 10 basis points. It went from 4.9 to 4.19 to 4.09. Slightly higher today, but it's starting to back off, and that is obviously a good sign for the market. But with the unemployment number coming out, and the market's still holding up, I think if interest rates hold around here, but I think the biggest number this week is going to be the CPI. Inflation, I think, might come out a little bit hotter than expected. We saw the numbers come out in January. That's when a lot of the vendors raised prices for the year. A lot of that data is not captured in the first January report. A lot of it flows over to the February report. So we could see a slightly hotter CPI number, and that'll put a little bit more fear in the market. We also have the FOMC, not much expected out of that, not a change in interest rates, but what Mr. Powell is going to say could have an impact on the market. So we'll have to wait and see. The big number, the Consumer Price Index, the CPI, coming out tomorrow morning. Also, a dovish Fed could create inflation. This is what we saw. This is the CPI in green. You saw it follow. This is what happened. It went up, it came down, and then it started to go right back up. This is the 1980s, so we'll have to wait and see what happens to inflation. I don't expect it to take off. I think later on this year we will see a more softening, but the easy part has been done as far as inflation. Now it's the hard part, trying to get shelter down, which is rents. They don't go down every month, and people sign a one-year lease. We're seeing insurance costs for car insurance, which have been going up dramatically. That is having an impact, and once insurance goes up, it usually does not come down. So those are the two big contributors to the higher inflation number that we got, the Consumer Price Index last month, and for February we get it this week. And that, I think, tomorrow morning when we get that, that could have a big impact on what the Fed does, what the Fed says, and what the market perception is on when the Fed is going to cut interest rates, and that could definitely have an impact on the market. Again, job openings declined to 8.9 million. That is a softening in the market. Payroll was up 2.75, 275,000 jobs created in February, but the January number was revised downward dramatically from what was originally reported. Wage growth came down, which is a good sign, and that was cheered by the market. This week we get the CPI, the Consumer Price Index, the Producer Price Index, we get retail sales, and we get the first consumer sentiment number. That's what we get. Don't forget, this Wednesday night, 6 p.m., we are going to do a tax time webinar. Making money is good, but if you can save money in taxes, just as good. And we'll give you some ideas how you can do that. So sign up for that. All you have to do is go to compak.com/seminars. It is absolutely free. It is a webinar. You can be at home and get some great ideas as you're putting together your tax picture. Looking at the technicals, S&P reversed down on Friday. That means it went above Friday's high, closed below Friday's close, and that is usually a sign for a pullback. This is the third wave. We could see a fourth wave. First support is around 50.65. That's the 20-day moving average. Then more support around 49.5. That's the 50-day moving average. 20-day, 50-day, and this is the 200-day all the way down here. But that's way down. I think anywhere down to about 49.30, 49.50, because this is going up by the time the market comes down. But first we'll see what happens to the 5,065 number, which is the 20-day moving average. On the weekly charts, again, 5150 was my target that I talked about, a long time ago, 2 years ago. We have hit that now. We got above it on Friday, but then we closed below it. So again, weekly support 4,800, 4,500, 4,250. So those are the numbers of weekly long-term support. Each one of these bars that you're seeing, the red and the green, is 1 week of trading. As you can see, it goes all the way back to 2020. You can see this is the COVID bottom. From there we saw this tremendous rally. Then we got this pullback right here. Then we started wave 1, 2, 3, 4, and a fifth wave right here. That's what the target was. If we can get decisively above 5150, then we are looking at about 5600 as the target. But first we've got to get above, and I think if the CPI comes out hotter than expected, we could see a little bit more of a correction. NASDAQ also, big reversal down on Friday, went above Thursday's high, closed below Friday's close, so that is not good. 15,951 is support. We're trading this morning around 16,000. That's the 20-day moving average. Break below that, 15.5 is the next support on the NASDAQ. NASDAQ has gone a lot. NVIDIA, all the AI stocks, I think they've got some room to pull back. Long-term target still 17.1 to 17,750. That's the Fibonacci projection from the high that we made in 2021. So we still have a ways to go to get there. But short term, this was resistance 16.2, which was the previous high. We got above it on Friday. Now we're back down below it. So we'll see how it holds up. I think long-term support is around 15.2. That's the weekly 20-week moving average. 10-year note interest rates below the 200-day, which is this magenta line right here. It is at 14.188. 4.188. We are at 4.104 today. So we're below that. We're also below the 50-day, which is the blue line right here, which is good and shows that interest rates, as I said, this was wave 1 to the downside, 2 back up, 3 down, and then the fourth wave back up. And now we should see a fifth wave down, but it might take some time. I think we're going to bounce around here for a period of time unless we get a stronger CPI number. Then we can see another move up in rates, and that could scare everybody. Crude oil sitting right around the 200-day, which is around $78. We were trading this morning at $78.16. Again, there was some chance of a ceasefire in Gaza, but that's sort of gone by the wayside. We'll see how things progress, and the problems in the Red Sea with the Houthis attacking shipping lanes right there. That is causing giving some support to the oil market. The small cap index, 208 to 210, was my target to the upside. We hit it on Friday, came back down. We're trading around 205 this morning. I think, again, hitting these targets on the dailies, support 202, then 198. Again, if we see a small cap pullback, how much this pullback, the small cap, if the S&P and the NASDAQ do come down, will be interesting to see if we can see a broadening of the market as people sell some of the tech. Do they buy into the other parts of the market? We'll have to wait and see. If the small cap holds up much better than the S&P and the NASDAQ, that could be a good sign for the market. Those are my thoughts. Those are my views. Again, don't forget to tune in to the podcast. It will be a much more 45 minutes. Javed and I will discuss the market last week, what to expect this week, what are our thoughts. We'll get into much more in depth. So make sure you sign up for the free podcast. Those are our thoughts. Those are my thoughts today. I will be back next week. Until then, good trading.
This presentation contains the current views and opinions of Moees Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.